Please be really careful if you're considering buying Robinhood stock. It could be a trap for growth investors, and let me explain why. You can see here that they have had a clear trend in growing revenues, although the recent quarters has not been that good. However, this being a brokerage firm in the financial industry makes it a whole lot harder to continue this growth rate that they have right now as a small cap company. Well, let's take a look at some of the potential competition. Let's say that they saturate the American market and they win a lot of the retail investors and they get as many customers as they can. What would happen if they were to try to expand to other parts of Europe? Well, in Sweden, for example, we have our own brokers such as Nordnet and Avanza, who are internet brokers and are capturing the market. In the Netherlands, they have DEGIRO, and they all have different banking regulations, and I do not think that this business model is fully scalable outside of the United States of America. They also have a lot more employees than other internet brokers, and they're suffering very much in terms of profitability. Take a look at earnings per share here, for example. As you can see, it's been very negative in the past when they did some really reputation damaging stuff, and you can see that they have been bleeding cash in 2021, although they made a slight profit the year before that. And you can also see the revenue numbers here in terms of earnings per share being all over the place for the quarters. If we compare them to the Swedish broker Nordnet, they have a price to earnings ratio of 17. You can't even get a price to earnings ratio for Robinhood, because they are not earnings positive. However, we can take a look at another price ratio, price to sales. I believe I calculated it to be 7 something here last time, with some of the recent earnings data put into place. However, no, it was 5, I'm sorry, it was Nordnet, the Swedish broker, that had price to earnings ratio of 7. So as you can see here, of course, 5 in price to earnings, so they're actually cheaper compared to a European competitor in terms of price to sales. However, I don't think that this is a growth stock. I think it should be valued as a value stock. It should be held to another standard, and in terms of that, well, then the highly negative earnings is just not cutting it. I think this is a trap for growth investors. I think that the risk far outweighs the potential rewards with the damaging reputation, with the lack of scalability potential in other parts of the world, and also high risk of regulation in the United States, as well as a consequence of the actions that his company has taken in the past. So I believe that there are other opportunities out there where investors can make a whole lot more money at a lower risk. Anyways, that's just my opinion. As always, hope you make a ton of money, whatever investments you decide to make. Take care now. Bye bye.